now let's proceed to the certain transactions and certain examples where we have limits without any RBI approval. So here we say the automatic routes in current account transactions where there is no approval is required as far as the money is being concerned, and these are also being governed as a liberalized remittances schemes of the RBI, where you go for a private visit, so up to 10,000 US dollars there is no approval is required. Gift remittances of 5,000 per financial year, then again there is no limit. Donations are there of $5,000, and then we have an exchange facilities for employment abroad, USD 1 lakh. Medical treatment abroad, again there is, as per the estimate of the foreign as per the estimate of the doctor, there is no limit is being governed. So as we can see that there are certain services where there is no specific approvals or any specific limits are being there as far as the transfer of monies are concerned, and these transfers are being very much legitimate and they have been approved by the RBI, that there is no specific approvals which are basically required as far as the transfer of money is concerned. So that's how we have a liberalized remittances schemes which is available to the resident individuals, including minors, that resident individuals can remit overseas up to $125,000 per year, for a permissible current account or capital account transactions, or if a resident is willing to acquire any of the shares or any investments outside India, that is again governed by LRS, which is liberalized remittances schemes, and it again allows resident Indians to go for a joint venture or a wholly owned subsidiary company outside India, and where the remittance is only up to 125,000, there is no approval is required. So there have been limits that where the resident Indians don't require any approval as far as the government of India is concerned, because there have been certain areas where they allow you to transfer the money and there is no specific approvals which are broadly required as far as the money transfers are being concerned. But if you go beyond a limit, then there has been approval and then you have to go with the RBI permission. But automatic approvals as well as liberalized remittances schemes are very much there in the government of India, where they allow you up to a limit, and if you want to go beyond, then it comes as a approval route, and up to that level there is an automatic route. So there is a concept of approval and automatic. So automatic is very much there up to a limit, beyond a limit we go for an approval routes. Then there have been certain schemes which is inbound investments when the investments are coming to India. And now let's focus on the FDIs and FIIs, because there has been a clarification from the Ministry of Finance that we need to be very much clear that what is an FDI and what is an FII, because there has been confusion of FDI and FII. And now we are coming straight away to a clarification that what is an FDI and what is an FII. So the ministry says that we need to work in conjunction with the international boundaries, and in the international levels we say that FIIs are the money which is generally defined as a hot money. And why we say hot? Because it comes very fast and it moves out very fast. So that's why we say it is a hot money. And FIIs investments are broadly in the secondary market and they are not in the primary market, and they are basically doing their trades in the foreign exchange, but at the same time as a portfolio investments. So when we talk about a portfolio investments in India, it is broadly a category of this FII investment in India. But friends, when we talk about the FDI applications and when we talk about the FDI approvals, we talk about the investments which are coming in the form of investments, or they are broadly in the form of joint ventures, or in the form of applications where we are basically investing within India in the form of corporate, and it is more of a primary market investment where we are basically investing as a strategic shareholder or as a joint venture for doing a business in India. So when we talk about the investments in the insurance sector, the limit has been raised from 26% to 49%. So we are broadly talking about the FDI norms, that it's a foreign direct investment which is coming to India, and it is not an FII money, because FII are generally coming in the secondary market, they are trading in the share market, and that's why they pour the money to the Indian markets and then they can withdraw the money at any point of time. That's why it is one of the hot money, and it is also known as night fly operators, because they are the night fly operators as far as the markets are concerned. They come to the Indian market, they move out to the Indian market very fast, but as far as the FDIs are concerned, they are basically the long term, and their presence and their investment is basically for the capital account applications rather than on their trading activities. So that's why the need of our in India is that we should focus more on FDI rather than FII, because as we know that many a times stock market also crumble the moment FIIs withdraw money outside India. So we should focus on that FDI, and that is what we say, the inbound investments in India in the form of FDI scheme, or it could be in the form of a purchase of shares by the registered FIIs, which are foreign institutional investors, or under the portfolio management schemes, or when we say that when we are investing in India in stock market, whether on repatriation basis or on non-repatriation basis. So as we can see that inbound investments in India is coming under different categories and under different legs as far as the basic investments are concerned in India, and we have in the form of depository receipts as well, because today we have an application of depository receipts as we have ADRs and GDRs, which are American depository receipts and global depository receipts. Today we have IDRs as well, which are Indian depository receipts, in which a foreign company can issue the shares in India, and it will be in the form of ADRs, as we generally have the American depository receipts or the global depository receipts other than America. Similarly, we have IDRs concepts there in India, and Standard Chartered is one of the company who has introduced this for the first time, as IDRs. Now inbound activities processes basically coming under different legs, as you can see, as an FDI policy. Now it depends upon the category of the investor first of all, then whether you are probated or your approval or there is an automatic route. Then the mode of remittance will be what, whether it will be NRE or inward remittances, then the procedural compliance of the investments, and then finally coming to the annual compliance. So we have inbound investment activities, and this activity go in different legs as far as the investments are there in India, because we need to be very particular about that whether this investment require any approval or it is coming as an automatic route. So that's what is an inbound investment activities as far as the investments are there in India. And here we can see in this slide that we have been given the various routes of investment in India. As we can see, automatic routes are there where no some specific approvals are required. Then we have approval routes where we have to give an application to Foreign Investment Promotion Board, which is FIPB, and they will see and they will give the approval in a short frame of time. As far as the defense sectors are concerned, or broadcasting or single brand or multi-brand applications. And then we have restricted list where we don't allow you to do the trades or investments in India. So these are restricted or prohibited applications. We have approval, we have automatic. Now here we can see we will have a fair idea about the foreign entities within India, and we talk about a foreign company, we talk about the limited partnerships, and we talk about an Indian company. So here we say that the entry strategies for a foreign entity could be that they can come to India under different legs. They can create an Indian company, a wholly owned subsidiary company, as we have Pepsi Foods or we have Coke in India. So these are wholly owned subsidiaries. They can come in the form of joint ventures. When we talk about ICICI Prudential, when we talk about Birla Sun Life, so they are broadly coming in the form of JVs. Or these entries could be in the form of as a foreign company straight away. You are investing in Indian company as a foreign branch office, or you can also have a LLP, which is a limited liability partnership. But broadly we are focusing on these two aspects as far as the foreign investments concerned to the Indian markets. Now here we have the permissible activities of the branches or of the BOs who are basically coming to the India, and they can do some of their activities of export and imports, or they can do some back-end activities for their parent company outside India. So branches can be established in India, and the branch offices will be working for their foreign counterpart with the approval of the RBI, with the specific approval of the RBI, and they will be engaging in the activities of their parent, right? So that's how we have these permissible activities of the branch offices there in India. As far as the overseas foreign direct investments are concerned, these investments could be there in the form of the capital contributions, or when they will be investing in Indian market as a wholly owned subsidiary companies or JVs or private placements or portfolio investments or via investments in stock exchange. So what I mean to explain you is that in this leg we need to understand what are the foreign investments coming to the Indian market, how the foreign investments come to Indian market, whether they form a wholly owned subsidiary company or they get into a joint ventures or they create a branch offices or they form a public limited liability partnership company, limited liability partnerships, so that their investments can be there in Indian market. So that is the bottom line as far as the foreign investments are concerned in India, and whether you will be doing automatic rule or approval route. So that we need to see from the course of activity or from the mode of the activity. So the possible routes could be automatic routes and approval routes. So here we need to distinguish between that there have been certain sectors which have been given by the government of India that you can basically set up and do business in India, without any approvals, and these are the automatic routes which have been given as far as their investments are concerned in the form of JVs or in the form of wholly owned subsidiary companies. And in the approval route, here we have that there is an approval which is really required as far as the investments are concerned, and you have to get it authorized by the dealers before you invest in the Indian markets and before you invest to the Indian territory. Now when we talk about the overseas offices, again we need to understand that there have been certain expenses which have been incurred by these overseas offices within India, and there has been a limit as far as their expenses are concerned and as far as their remittances are there, right? So they have a limit on the remittance up to 15% of their average annual income for their initial expense, and similarly of the recurring expense it is up to the 10% of their average annual sales. So what we mean to say by doing this is that whenever you set up an overseas office in India, then you must limit your expenses on the business, and you will not be allowed to do an expenses beyond that limit. So that's why it's very important that any of these investments coming to India, we will allow you expenses up to a limit, and beyond the limit you will not be allowed to do the expenses as far as the branch offices are concerned or as far as the representative offices are concerned in India. So now before I come to the next important aspect, so what all we have concluded in this part was that we are discussing about the automatic routes, the approval routes, and the inbound activities, and what are the different segments you have as far as the investments are concerned in India. So friends, now in my last conclusion aspect, what we are trying to understand in this FEMA Act is that there have been certain accounts which have been opened and allowed to open by the Indians to trade in foreign exchange, and broadly these are NRE accounts or NRO account or FCNR account, and these accounts could be opened by generally the NRIs or person of Indian origins, so that whenever they are investing in India or trading in any type of investments in India, so they can get the benefit of those interest rates as well, because in India the interest rates are higher as compared to the other part of the world. As you are aware of the fact that in China the interest rate is 1.5%, or in US the interest rate is 2%, but in India the interest rate goes to 11% or 10%. So those NRIs who are willing to invest in India, right, they can open these type of accounts and they can get the benefit of that interest rates as well. So finally, in my conclusion word, I just want to explain you that FEMA is basically a regulation which talks about the management aspect of the foreign exchange. It tries to facilitate your foreign exchange transactions, it tries to help you out and to give a clarification on the foreign exchange trades, so that you can actually facilitate the transactions and you can get more foreign exchange for the Indian as far as the investments are concerned. And at the same time, we should also focus on that what are the basic applications in this act, so that we can do their application sites and we can also apply their concepts. So when we discuss in this FEMA Act, we talk about the resident applications first of all, then we talk about the basic investments routes there in India. We are explaining about the capital account applications and current account transactions. Then we are talking about the different approval routes there in India, whether it is automatic or there is an approval or there is a probated route. So, and then we are coming to the next important point about whether it is an FDI investment or there is an FII. And then again we are talking about that there should be a legitimate way of money, and we should prohibit any type of money laundering or any type of hawala transactions, because we don't want any type of these transactions to happen in India. So FEMA Act is basically a management act in a way that it is facilitating your foreign exchange transactions, helping you out to do the business in India, trying to regulate your all type of foreign exchange transactions and try to keep currency, fixing with dollars, and there should not be any volatility on that application as well. So we are more focusing on the FDIs rather than the FIIs, as we just discussed that FI is a hot money, FDI is a long-term concept. So that is what is the governance of that FEMA Act. It talks about the various regulations which has been defined about your do's and don'ts on the foreign exchange transactions. Thank you so much for your time and for your patience listening. Thank you.